Hello, hello. This is Peter Nelson with Nelson Insurance Advisors. And once again, we have the man, the myth, the legend, Logan Hertz from Hazeltine LLC. Logan, how you doing?
Hello, Peter. Good to see you.
I think we're on part 8, and I think this might be the final one here. So let's get right into it, Logan. Let's wrap this thing up. Maybe at the end, after you get through the email, maybe we'll just have a little trying to summarize what we went through. And then also maybe talk about, we're not going to promise anything, but we're maybe going to chat a little bit about what we were just talking about with maybe how we're going to elaborate on this whole deal. So go ahead.
Yeah, so this is part 8. Again, we have the 75-year-old who has all of his money in the market, does not have enough to retire, and his financial advisor is telling him, basically bullying him into keeping all of his money in the market and never withdrawing it. There is effectively no retirement plan other than give me all your money and let me keep it forever. That's really what it boils down to. And so we're going through his comments. We're really at the end of the email here, where the financial advisor is resisting with every fiber of his body anything that might actually help the client, right? Because it might result in less money in the market, right? So we are now towards the end of the email, okay? So here is what the financial advisor says. Ultimately, we have a fiduciary obligation to you and your wife to act in your best interest at all times. This is, like I said before, there's always an inverse relationship between how much somebody says something versus how much they actually do it, right? Let's imagine you're the CEO of a company. You tell people, hey, I just want to reassure you, your jobs are safe, no problem. By the way, Peter, just want to make sure, like, hey, your job is safe, no problem. Okay, everything's fine. Okay, Peter, everything's fine. There's no problem with the company. Your jobs, don't worry about it, right? The more he says that, the more you're going to be suspicious, right? Like, wait a minute, what's going on? Why do you feel the need to reassure me all the time? And that's exactly what's going on here. Why does he have to wear on his sleeve, hey, I'm a fiduciary, I'm acting in your best interest? Peter, I'm acting in your best interest. I'm a fiduciary. Really, I'm acting in your best interest, right? The more he repeats that, the more you know it's not true. It's exactly the opposite, okay? The clients can tell who's acting in their best interest and who is not. And this particular client is in a web of psychological manipulation where his financial advisor has put him in this position, and now he feels like he has no alternative, right?
Yeah, absolutely. I'm just thinking right now with what's going on, the volatility in the markets right now. What do you think this advisor is going to say to him after let's just say if hypothetically his portfolio corrects by 20%?
He's going to do the same psychological manipulation. He's going to be like, hey, stop being a little coward. Keep your money in the market. You know, this is the price of having large gains, right? It's a very effective tool of psychological manipulation, saying basically, hey, if you cut bait and run when the market crashes, you're just a little wimp, right? Come on, keep your money in the market, right? Keep it all in there. It'll be better for you. You want to be strong, don't you? You don't want to be weak, right? That's the way it's presented, right? And this guy's 75 years old. Okay. Shouldn't we be de-risking? I mean, even if you're going to have some money in the market, shouldn't we be strategically de-risking, moving into assets that provide us with income, like an annuity, right? Shouldn't we be concerned with long-term care? Shouldn't we be concerned with death benefit? Shouldn't we be concerned with legacy planning? Shouldn't we try to utilize your best single asset, which is your paid off house? Your financial advisor never even once brought up to you a reverse mortgage or any way to strategically use the equity in your home. Nothing at all. And by the way, his home is worth more than all the money he has in the market, right? So which investment, quote unquote, paid off better, right? This money in the market or your house, which you didn't even necessarily get from your financial advisor, right? But,
Yeah, I mean, could you imagine now, just curious, I mean, do you know what the value of the guy's house was roughly?
Yes. Well, I would say it's about at least 20% more than the total amount of money he has in the market right now.
Okay. So, let's just say hypothetically, I think the rule is age minus what is it? Age minus 35 right now for the amount you can get out of the reverse mortgage based off the value, right? So if he's 75 minus 35, about 40%, I think he could probably get out of reverse mortgage. Does that sound about right?
Yeah. So you immediately got 40% of your home's value in liquid, with no repayment terms while you're alive, right? So it's a line of credit that grows, right? That's not a static amount. It grows. Okay. So yeah, that'd be a phenomenal tool. This financial advisor never even discussed that with them.
So, I mean, if
Poo-pooing
those,
the idea that you might need some form of long-term care protection for a 75-year-old type 2 diabetic and a 69-year-old wife. Apparently, having money in the market takes care of everything, including long-term care. You don't need long-term care insurance. You got money in the market.
right? I mean, if let's just say hypothetically the house is 500,000, doesn't that mean that he would instantly have he would have a line of credit of about 200,000 with that reverse mortgage? That
Right.
Yeah.
Right.
So, I mean, even if he didn't touch it and it just sat there in the reverse mortgage and it's a growing line of credit, right? So right there's your long-term care parachute, if you want to call it that, without even doing anything else. I mean, gosh, that would be, to him, that would probably be a game changer.
Yeah. See, the strategies we propose make you more liquid. The strategies this financial advisor proposes make you less liquid, because it's take your money and lock it up in jail in the market and don't ever touch it for anything or anyone, right? So that's basically what it boils
I
down to.
always, I'm actually starting to use that now, Logan. I love that, lock it up in jail. One of my mentors, Curtis Cloak, he always likes to use the wording, free the hostages. So what you're saying and he's saying, it's kind of similar, right?
Yep. I know a good high producer who does a lot of work, and he'll take people through. Unlike this financial advisor, he actually takes you through a discovery process. And when he figures out how much money you have in retirement accounts, he'll be working with them on a paper, and he'll draw vertical bars over the money you have on a retirement account. And the client's like, what's
Oh my
that? He's like,
gosh, I
well, that
love
money's
that.
in jail. That money's in jail. So
Love
yeah.
it. Love it. So you don't get that everywhere, folks. You don't get that. All right. So let's wrap this up. What do we got?
Okay, so now he says, he mentions the name of his company. I won't mention it, but this particular company that this financial advisor works for was organized in part as a fee-only advisor to avoid situations like this. He doesn't specify what this is. You mean like you want to avoid actually giving the client what's in his best interest? Is that what you're saying? You want to avoid taking money away from you where you can make fees off of it? Is that what you're saying? I would like to know what this is.
Well, you know what this is? You. They're trying to prevent you from happening, Logan.
Yeah, and why did I happen, right? Again, like you said, if
Exactly.
you were taking care of your clients, he would not be interested in talking to me. He would not give me the time of day. He'd say, look, I'm taking care of you. Stop wasting my time. But instead, he's very nervous, right? He's uncomfortable because we haven't taken care of long-term care. We haven't taken care of legacy planning. He's got all this risk. He has no liquidity. I can help him with that, right? So the company was organized in part as a fee-only advisor to avoid situations like this. Doesn't specify what this is, because we truly believe whole life insurance is a product most people just don't need.
Wow. Wow. What a statement.
First of all,
Say that again. I want to hear that one more time.
we truly believe whole life insurance is a product most people just don't need.
Just don't need. So the majority, what he's saying is the majority of people don't need life insurance. Wow. That is quite the statement.
Yeah. And again, like I said, it's totally disingenuous. Well, you don't need money in the market. You don't need a financial advisor. You don't need any financial product. You don't need any insurance product. Duh. It's a very disingenuous way of stating it, right? The question is, depending on your situation, your financial goals, would a whole life insurance policy fit into your overall strategy, right? And there's lots of different ways you can use whole life insurance, right? So do you need it? No, of course not. Whole life insurance is not a need product. It's a love product. How much do you love your family? How much do you love your spouse, your children, your grandchildren, right? That's the question. Okay.
Well, it could also be a greed product too, right? That's what I say.
He says most people don't need it. Well, who owns all the whole life insurance? It's rich people, it's the banks, it's corporations. Like all of the smart money that knows what they're doing has a lot of their money in whole life insurance. maybe we should not follow the advice of people who are not rich and who don't profit from whole life insurance and who profit from these alternative vehicles. Maybe we should follow the example of the people who actually got rich and see how they did it, right? Walt Disney, Ray Kroc, right? They
JC
used whole life
JC Penney.
insurance. Yeah, they used whole life insurance as a financing vehicle, right?
Yep. And by the way, if you want to watch a video, this blew my mind. Ogden Gunpowder, which pretty much supplies a lot of the gunpowder in this country. How were they started? With cash value life insurance, and I did a video on it. So if you go onto my site, you can watch that. It was like, I'm a huge, everybody knows I love hunting and fishing and guns, and I was watching this video, and I was like, oh my gosh, he loaned money. It actually his I believe it was his son or his grandson said that he loaned right after World War II, loaned money out of his cash, or he said whole life or cash value life insurance policy to start the company. This is the way companies are started, right?
Yeah, and just to repeat a theme that's been throughout this, he's confusing whole life insurance with the infinite banking concept. He says most people don't need whole life insurance. Well, here's a question, Mr. Financial Advisor. Do you think your client needs a bank account? Do you think he's going to be using a bank account? Do you think he's going to be making purchases? Do you think he's going to need to buy stuff? Yes. Okay, then maybe instead of letting Wells Fargo profit from all of that activity that he's going to be doing, that he has to do to live, maybe he should set up his own private banking system so he can now profit by managing his own cash flow rather than putting it through a Wells Fargo checking account, by financing his purchases from his own private bank rather than using the conventional banking system. So now he profits from all of that activity. Notice I said nothing about whole life insurance. Okay. We're talking about reclaiming the banking function for yourself. So now you control all of that activity and you profit from something you're going to be doing anyway, which is banking, right? So again, he can't think conceptually. He's getting lost in whole life insurance, which he clearly does not understand. And, not surprisingly, it's financially more profitable for him if you follow his quote unquote strategy rather than potentially using whole life insurance, right? And you can do both, of course. It's not an either or scenario, obviously. If you want to invest, go right ahead. I'm talking about your banking needs, which are separate from how you invest, right?
Yeah. And once again, if he would just, I'm sure this guy owns some bonds, and it's been proven how many times if you just take some of the bonds out of your portfolio, if we're not going to get into a total infinite banking, but at least even just talking about whole life in a portfolio, you take out those bonds, you put in the whole life, I can guarantee you that'll be a more effective and efficient portfolio. It's not my opinion. It's based on mathematical, scientific, and economic facts.
Yeah. So what he's really saying is we set up our firm this way because we don't profit from whole life insurance. We profit more by taking your money and locking it up in our jail. So that's what we're going to do. That's what he's saying, right? Our financial incentives are aligned with this strategy, not that other strategy. We don't care what's in your best interest. We're going to do what's in our best interest, right? Which is lock your money up in our jail and we'll keep it forever, right?
Right.
So,
okay.
Just don't need and are better off with a prudent investment strategy. Here we go again, comparing whole life insurance to an investment, right? It's not an investment and it's not an either or scenario. You can do both, right? If you want to invest, that's fine. Okay. But you're still
both,
gonna need
right?
you're still gonna need a bank account, right? I mean,
yeah, you should do both.
Yeah. He acts like, again, it's another straw man argument. He acts like I'm saying, don't invest your money, buy whole life insurance instead. That's not what I'm saying, right? You can invest your money, fine. Go do that. Like I'm not telling you, but I would encourage you to, again, ask yourself the question before you get into any investment. How much does this investment pay me? Right? When you invest in a rental property, cash flowing real estate, right? That investment pays you. When you invest in a business, that business pays you on a regular basis, right? When you put your money into these so-called investments, what you're actually doing is speculating because they don't pay you anything. The goal is to keep your money locked up forever. Well, they promise you a quote unquote return on investment, which is how they can give you something without actually giving you something. Like I said before, the number you see on your statement is really just a form of advertising. That number's not real. Okay. It is not real, right? How much money do you actually have? When you try and get access to it, then you find out how much money you actually have, right? And of course, your financial advisor, one like this, is going to fight you tooth and nail, right? He's not going to let you have any of it. So whose money is it really? How is that affecting your lifestyle, right? As Benton Penn has said, because Benton Penn does a lot of like retirement planning, and he talked me through his approach, and I pointed out after he talked me through it, I'm like, Benton, you never mentioned once return on investment because it's not relevant. It doesn't matter when you reach retirement. It's all about income. So yeah, he said, I've never seen anyone spend an 8.2% return on it. Right? How is this money affecting your lifestyle? It's not at all. It's just locked up in jail. And the number they give you on your statement is just advertising.
You can't spend ROR. You cannot, right? Rate of return. You cannot spend it.
On the other hand, something like an annuity puts money in your pocket every single month, right?
Yeah.
And you can't outlive it. We're not taking on risk.
By the way, I mean, that's right now annuities, fixed indexed annuities. My gosh, talking about we're going to be entering potentially a recession. Ladies and gentlemen, if you watch this video, if you're not actually looking at, if you don't already have a fixed indexed annuity or even a fixed annuity right now with the higher interest rates in your portfolio, please reach out to Logan here, reach out to me. We'll show you how that can take part. Now we're talking here about more, on the infinite banking side of this, but still, please reach out to us right now. There's that retirement red zone, the 5 years before the retirement and the 5 years after, where you're most susceptible to getting hit by a market downturn. It's what we call the sequence of returns risk also. So anyways, I just wanted to put that little plug in because I think it's so important right now.
Yeah. And one of the themes that comes up here is statement wealth versus contractual wealth. Statement wealth is where a lot of poor and middle class people have their money. And it's what it sounds like this guy does. He gets a statement online or in the mail from his financial advisor's company telling him, here's how much money you have in the market. Okay. But it doesn't really mean anything. It's not impacting you at all, right? Question is, who's absorbing the risk? When you put your money in quote unquote the market, who's absorbing the risk? You are.
Right.
You absorb the risk. They collect their fees regardless of performance, and you take on all the risk. Okay. Contractual wealth is where rich people have their money. With contractual wealth, who's absorbing the risk? Not you. Somebody else, a major financial institution, is absorbing the risk and guaranteeing you something. When you put your money in whole life insurance, when you purchase an annuity, the insurance company is absorbing the risk because that's what insurance companies do. That's the service they provide. For a fee, yes, there is a cost, duh. They are absorbing risk for you. So when you take out a whole life insurance policy, they are guaranteeing you a death benefit. They are guaranteeing you could advance yourself a portion of that death benefit should you have a long-term care need. And they are guaranteeing your cash value will grow at a certain rate. And they are guaranteeing you a policy loan feature, right? They're absorbing all the risk, which is why if you want to buy a whole life insurance policy, you have to qualify. You have to go through underwriting. They're not just giving it to you, and they will limit how much you're allowed to have, right? Whereas if you want to go and buy mutual funds, buy them all day long. There's no qualification process. They're not going to ask where that money comes from. They don't care how irresponsible you are because they're not taking on any of the risk. So why do they care? If you lever up irresponsibly and put a bunch of money in the market and you lose it, they don't care. No money off their back, right? So statement wealth versus contractual wealth. Okay. So most people have only statement wealth. Okay. You need to have contractual wealth. Okay. That is where rich people keep their money.
Yeah. And I think I like to talk about that too, that having a contract, versus having money sitting in, say, a bank account. As I say, is that really a contract? And they're like, no. Well, of course not. Technically, the government, because let's face it, the government really controls all the banks, whether people want to admit it or not. The government could come right in tomorrow and say that, hey, you can only take out X amount of dollars a day from your bank account, right?
Well, it's happened before. Bank holidays during the Great Depression. I mean, it's happened.
By the way, it's happening in, I talked about this before, right now in Lebanon. Okay. Right now in Turkey, actually, which is, by the way, a NATO country, people can't just take all their money out of the banks if they want to. They're limited to how much they can take out. This is happening all across the world, ladies and gentlemen. It's happened, like you said, in this country before, and we're nearing the 100-year anniversary. What are we, 6 years away from the 100-year anniversary of the Great Depression? And we actually are projecting another one is potentially coming around 2030. My gosh.
Yep. They never mention risk. This guy had never, ever, not once has he brought up, let's do a risk management strategy. I've never heard that out of his mouth, right? We're just going to assume we get some double-digit rate of return. And if there are losses, yeah, whatever, right? There's never, okay, it's like, if we're going to take on risk, then there needs to be a risk management, a risk mitigation strategy. Nope, nothing. Just throw it all in there, put all your money in the casino and hope for the best. We're not buying put options. We're not doing anything that might potentially mitigate the risk.
And I don't want to go harp on this too much, but when I was managing some money, not a pile, but it was enough. 07, 08. Not managing, but I mean, I had people's monies invested. It really bothered me. It changed the way I look at things in 07, 08. Because I did have some people near retirement and they took a huge cut. Now everybody said, well, the market came back. Yes, but they weren't ready. They couldn't recoup those losses fast enough. And it's really, I have a tough time with if some advisor is not, if that doesn't bother them, I really don't think you should have them as an advisor. They should have a conscience. They should have this moral, I think, higher calling that says they're not okay, that they're going to treat their clients' money the same as they treat their own money. It just,
yeah, I could not, I would suffer a psychological breakdown if I had a 75-year-old client like this and I had done this to him, right? Why is he in this position? Because his financial advisor has cornered him and manipulated him into putting all of his money in the market. And that's why at 75, he's still working. He can't retire. He cannot. You know, I mean,
he's still working.
Yeah, he's still working, earns a modest income. He couldn't, you know, he does not have enough money saved up to retire. And again, I say I'm already falling into the Wall Street, save up a bunch of money in a big nest egg. No, that's not how you retire comfortably. It's generating income. That's how you retire comfortably, where you have enough passive income that you can live off of, right? Things like that, from cash flowing real estate, from whole life insurance, from annuities, right? Businesses, things like this. It's not about the size of your nest egg. Okay, good if you have a nest egg, but the question is then how are you going to turn that into income? That's where something like an annuity could come in, where you can annuitize that nest egg and actually turn it into tangible income, right? So yeah, and there's no plan, there's no framework, there's nothing behind this but sales and marketing and psychological manipulation. There is no written plan, right? Like, show me the plan. There's nothing at all.
Because you're just supposed to have all the money in the market.
Yeah. Okay. And are better off with a prudent investment strategy. Yeah, okay. Prudent. Yeah, that's a relative term. Let me know if you'd like to discuss any of the above in further detail. Thanks. And that's the end of the email. But it's all this long, self-righteous, condescending lecture that shows that this financial advisor and his company have nothing but the utmost contempt for their clients. This is the way they treat them. They lecture them like they're 3 years old. Say, Johnny, you know, you need to keep all your money in the market. You don't want to be a little coward and withdraw your money because you're worried about risk. That would make you weak. You don't want to be weak, do you? You want to be strong, right?
You know what this reminds me of in a way? The United States government. Right?
Yeah. Well,
just the way they want to tell you, they want to, oh no, you don't know what you're doing. Just trust us. We know exactly you know what to do with your money. We know all this. Just let us handle it. We'll take care of it. We're great.
Yeah. So we've now reached the end of the email. We will probably do at least one more episode, maybe kind of summarizing and potentially talking about some other things. But I think there's a lot of food for thought here. I think we've covered a lot. You know, and I hope that people when they're meeting with their financial advisor or they're thinking about their financial future, think about the themes that came up here and ask good questions. And they always use that phrase investment strategy. No, that's too narrow. That's too narrow. It's okay to have an investment strategy, but that's just one part of your overall financial picture, right? If you ask rich people how they got rich, very few of them will say, because my investment strategy paid off really well. Unless you're starting with a lot of money, generally speaking, or you're speculating in super high risk type
and got
assets.
lucky with some,
Yeah,
crazy
and got lucky, right? In general, people don't get rich because of their investment strategy. Their investment strategy can help, okay? But usually when people get rich, it's because they invested in businesses and real estate, right? They're generating income. That's what they're doing. So your overall financial picture cannot be just buy mutual funds. And by the way, let me explain how mutual funds work. There's a book called The Problem with Mutual Funds, which was recommended to me by people I trust, but I actually haven't read it. But here's the deal, Peter. Okay. You and I are going to go into business together. Okay. You're absorbing 100% of the risk. You're putting up 100% of the capital. Okay. If things go well and we see gains, I'm going to take 80% of the gains and I'll leave you with 20%. Right. In the meantime, I'm going to be charging you fees and I'm going to be collecting those fees regardless of performance. No matter how horribly it performs, I'm still going to collect my fees. Okay. And then if it goes down, you take 100% of the losses. Does that sound like a good deal to you?
Depends what side you're on.
I just described to you mutual funds. And that's where the vast majority of, when people say putting their money into quote unquote the market, they mean mutual funds. And that is how mutual funds operate. And you're right. People some of the people who've gotten super rich got rich selling mutual funds, right? With all these financial institutions. But people don't get rich by buying mutual funds, right?
Yeah. And like I said, I'll say that I do offer them and I do have people in them, but at the same time, never once would I tell you that, yeah, it's that everybody should have them or they should have a majority of their money in them, right? You can have some, fine, but make sure have a truly diversified portfolio, which does not mean just stocks and bonds and mutual funds and stuff like that, right? So
Yeah, and ask yourself why you're doing these things. Because, when it comes to, say, retirement accounts, some people think I'm against retirement accounts. Well, not necessarily. It's just so many people, they just put their money in retirement accounts without even thinking about it. There's no strategy, no plan, no thought process. They don't really understand what they're doing or why they're doing it. They're just automatically, sometimes even by default, contributing a portion of their income to a retirement plan. It's like, wait a minute, what are you doing here? Why are you doing that? Right? If someone can, and there are instances where it makes sense. Okay. So someone can explain why they're doing it, why it makes sense, no problem. But so many people do it without even thinking about it, right? Because they just want to abdicate the decision-making responsibility to somebody else. So they can just put a check in the box and say, yep, I'm doing the financially responsible thing without really taking the time to educate themselves about how it works.
And the one final thing I think out of doing this, which it was really, had me thinking about a couple things, but the number one thing I got out of just going through this with you, Logan, was that we do a really disservice. We've done a disservice and especially the financial services side of the business about, like you said, the nest egg. You got to build up a whole pile of assets when that is not the conversation. It's income, right?
Right.
So
And what is an asset? Ask Robert Kiyosaki his definition of an asset, right? An asset is something that, according to him, puts money in your pocket every month, right? If you have a rental property, it's paying you every month. If you have a business, it's paying you every month. If you have money in mutual funds, is it paying you? Is it putting money in your pocket? Or is it just sitting there doing nothing? Is that really an asset? Depends on your definition, right? I mean, it's an asset in the sense that a car parked in your garage is an asset in the sense that if you sell it, you get some money for it, right? So if you sell your mutual funds, yeah, there's some dollar value to them, hopefully, right?
Or if you're having the, the gains coming out every year, but most, let's face it, most don't have that happening, right?
Right. Right. So yeah, build up a pile of mutual funds, basically. Are those really assets? Yeah, that would be my question. If any asset you buy, the question to you should always be, how am I going to monetize this asset, right? So if you're putting money into a retirement account, before you put it in, ask yourself, how and when and how much am I going to get income from this? And if you have a good answer to that, where it makes sense, great, go ahead and do it. But when most people put their money into mutual funds and retirement accounts, there is no plan to take income ever, right? And it's just, yeah, it'll work out. Well, hold on. If at some point it's not putting money in your pocket, what good is it doing you, right? The other thing that Garrett Gunderson brought up too that I thought was interesting is that he was talking about some of the people who criticize whole life insurance, how they don't make because they're locked in. I think it's because they're locked in this return on investment mindset. They talk about all costs as if they're the same. So if you go out and buy some ice cream, they treat that as a cost, which it is. That's just money that left your personal economy. Done. Financially speaking, you got no benefit from it. Okay. And they treat that the same as if you pay for a homeowner's insurance policy, right? And it's like, wait a minute, those two are not the same thing. When you go buy ice cream, you're not getting any financial benefit from it. When you buy a homeowner's insurance policy, you are absolutely getting financial benefit from it, right? It's not a quote unquote return on investment, okay? But it's absolutely giving you a financial benefit, right? So when you're paying money into a whole life insurance policy, same thing. It's not a pure cost. None of that money is leaving your personal economy. All of it stays in your whole life insurance policy with the death benefit, with the long-term care protection, with the cash value, all the things you're getting from it. It's not a cost, not in the same way that buying ice cream is a cost. It's an enormous benefit to you, right? So again, we cannot narrow everything down to return on investment. We have to look at it more broadly. That return on investment metric is a totally self-serving Wall Street metric because again, that's how they can give you something without really giving you something, right? They can show you a bigger number on a page or probably project out a bigger number on the page. Meanwhile, the number is actually getting smaller. In reality, they can project it out by saying, yeah, you'll get 10% returns, Of course, there's no guarantees behind that, right? Whereas with whole life insurance, you have guarantees. Annuities, you have guarantees. And even just standard property and casualty insurance, right? It's protecting you. Someone else is absorbing the risk for you. That's what they're doing, right?
Yeah.
You want someone else to absorb the risk whenever possible. You don't want to absorb any more risk than you have to. And if you do take on risk, have a risk mitigation strategy. This guy, he has no risk mitigation strategy. They're putting all the money in the market. They're taking on all this risk with no strategy to mitigate it whatsoever.
Yeah. And I still say, by the way, now, one of my mentors says the greatest advantage to cash value life insurance is to help pay for a long-term care risk. But I would argue the greatest advantage to cash value life insurance, especially whole life, is being guaranteed to never lose any money. I mean, talk about when to use mutual funds or ETFs. Let's keep the money in a whole, let's do an infinite banking type of deal. Let's wait for a market crash. Let's access the money. Let's buy low. Let's ride that puppy back up. Let's take our gains. Let's get out. Let's put the money back into the, cash value life insurance policy. And let's take advantage of every single government, Wall Street, and bank screw up for the rest of our life. Wouldn't that be an amazing strategy? But do we ever hear that from a financial advisor say that? Heck no, right?
Right. Look at Warren Buffett, okay? Is Warren Buffett the best, arguably the best investor of all time? Is he focused on return on investment? That guy carries more cash in his portfolio than anybody else. His portfolio is always more than 30% cash. You can look at it, right? I mean,
and they make fun of him sometimes.
He was sitting on a ton of cash, and when COVID crashed, guess who swooped in and started buying up companies on the cheap, right? So, with this financial advisor, if you're focused on return on investment, you're always going to be fully invested all the time. You're never going to have any cash, which is not what smart, prudent investors do.
Right.
And to your point, Peter, the best place to store cash is in cash value life insurance, because then when you use it, it keeps earning for you.
Yeah. And see, here's the thing too, Logan, and then we'll wrap this up. it's really tough to quantify what the ROR on doing a strategy like that, right? So let me just give a quick synopsis of what I'm talking about here. You got, let's just say, $100,000 in this cash value life insurance policy. The market crashes 50%. That might be a good time to buy into the market. You access via policy loans out of the policy, you buy into the market, and what typically happens right after a market crash? Oh my gosh, things are bad. We're the government. We're going to stimulate the economy, right? And the minute you hear that, stimulate the economy, they're going to print a whole pile of money. What's going to happen? Market's going to take off like a rocket ship. You write it back up. Take your profit, get the heck out, put it back into the cash value life insurance policy. Ladies and gentlemen, that is what I've kind of built my practice, my career on, is that concept right there that practically no one wants to talk about.
Yep. So you'll be making 3 to 5% gains in your cash value life insurance policy. And then when the market crashes, you'll make like 300, 400% gains over a 2-year time horizon, right? Because you're buying in at the bottom because you have the capital and other people do not, right? So yeah, what happened? This is probably an outdated metric, but the think the logic behind it is correct, which is that there were more millionaires made in this country during the Great Depression than at any other time in American history.
I believe it.
It's absolutely true. What happens with rich people is they're not wiped out when quote unquote the market crashes, meaning the S&P 500. Okay. What happens is their wealth is always expanding. And then when there's a crash, their wealth expands exponentially, because when there's an economic crisis, wealth doesn't disappear. It doesn't just go poof and go away. All the factories are still there. All the cars are still there. All the farmland is still there. All the real assets are still there. Okay. And then what happens is they get transferred from people who were not prepared for the crash to the people who were, right? That's what happens. So you'll make slow, steady gains during the good times, and then you make enormous gains during the bad times, because that's where money is transferred from the 80% of people who are not prepared and who are just following their financial advisor's advice and putting their money tracking the S&P 500, right, to people who were more had a truly prudent investment strategy, to use this guy's idiotic phrase, right?
Yeah. But think about,
where's your cash position? I don't see a cash position in your portfolio. What's your option strategy? I mean, this is very rudimentary stuff, like buying put options to protect your position. That's a very rudimentary thing. Why are you not doing that? Yeah. And the reason, Peter, again, the reason why they have no risk mitigation strategy is because the client is absorbing all the risk. Why do they care? They don't care about mitigating risk. It's just a cost to them. They're not going to spend any money to mitigate risk when they're not the ones taking on the risk. Oh. Right?
It's almost like a religion or a cult in a way, if you think about it. It's like, okay, we should all suffer together. When things are good, we should all be good together, but then we should all suffer together during the bad times, right? Because I was sitting with a client the other night, and I said to them, I said, they had just moved they had recently retired, moved a bunch of money into a fixed index annuity that we offer that's pretty killer right now. And I said, what's amazing about this? I said, you could be sitting in your basement, rubbing your nickels and everything together, hoping for a crash, because you're guaranteed to not lose any money. But then the following year, when you put your money into the index, you can ride that bad boy up and take advantage of it. And they're looking at me, and I said, I know. It doesn't sound right in a way, does it? That you should be able to take advantage of this the way. They're like, no, it doesn't. But you see, they're okay with it, but that's the mentality. People don't realize, they think they can only take advantage of things in the good times. That's not the case, ladies and gentlemen.
You'll now be in a position to help people, right? If you're prudent and you manage your capital and you're in good position, you can now actually help people when the bad times happen. Other people who are in trouble, you can now help them because you have capital. But if you didn't have the capital, you wouldn't be in a position to help them. And the other thing that's interesting too, Peter, is how do they measure when it's good times or bad times? Well, the way they measure it is this completely artificial metric, the S&P 500. When it's going up at a certain rate, apparently times are good. When it's going down at a certain rate, apparently times are bad. What? That's a total non sequitur. Okay. My business is not affected at all by the S&P 500. Okay. In fact, my business tends to do better when the S&P 500 is crashing, because then people are more willing to look at alternatives when they see their 401ks, their mutual funds going down in value, and like, man, there's got to be a better way. Yes, there is a better way. Okay.
Right.
Rich people are not affected by quote unquote the market crashing, because again, it's not a market. It is not a market. The S&P 500 is not a market. It gives markets a bad name. This is why I can understand why people are skeptical of markets and they feel like markets are evil, because what they think of as quote unquote the market is not a market. It's a totally self-serving, artificially created Wall Street metric. I don't want my wealth tied to their wagon. Okay. I would rather have my wealth in places that I can control it and I have guarantees. I don't want to tie my wealth to Wall Street's train and let them control where it goes. I don't want that.
No, I don't. I know the majority of my savings is going into whole life.
Yeah,
Okay.
and notice you used a good word there. That's savings, not investing, not speculating, saving. Keyword there is safe, right? It's safe. You have guarantees. It's not exposed to market risk. When you buy mutual funds, put your money in 401ks, you are not saving. That is not a saving vehicle. Okay. This is why so many people are nervous about retirement, because all their money is locked up in a Wall Street jail where they can't get access to it and it's all at risk. And they have no idea how much income they're going to be able to get out of it. Right.
Right. And that's the thing too. I mean, we could harp on this all. The average advisor does not really know. They're built to accumulate assets. They're not built to distribute them. And there is, like we've talked about, Mount Everest, right? The majority of people die on the way down, not on the way up. 80% die on the way down on Mount Everest. Okay. It's the same way in retirement. And
Yep.
I think Logan, wrapping this up, I really think I love what we do, being insurance professionals. But I'm terrified of what's coming, because I know there's going to be a whole bunch of people that are going to get wiped out. Now I'm optimistic at the same time, because I'm planning on taking advantage of it, and I hope my clients do too. But at the same time, I feel bad. There's going to be if this next Great Depression hits, they're going to get wiped out. So, but
Yep.
anyway, all we can do is fight the good fight, as they say, and speak the truth, right?
Yep. And I did want to point out one more thing that I was thinking about. The quote unquote rules and regulations are not set up to protect the consumer. They're set up to protect Wall Street. And let me give you an example. Let's say somebody has their money locked up in jail, either in a retirement account or mutual funds or whatever, where it's locked up and your financial advisor is telling you don't touch it, right? Or if you do, there will be penalties, right? Some people have done this. I know people personally have done this. You can look up Bob Murphy. They're incredibly brilliant economist. This guy knows about money. Okay. He's not a dumb guy. What did he do? He cashed out his 403b. He cashed out his retirement account, paid the taxes, paid the penalties, and put it all in whole life insurance to do the infinite banking concept. And he wrote an article about why he did that. Okay. If you advise a client to do that, you could be in serious trouble, right? If you're not securities licensed and you do that, right? Because Wall Street wants to protect their money. You're not allowed to take money away from them. Okay. But on the flip side, you could make the client a horrible recommendation and Wall Street would applaud you for it and there'd be no problem. Let's say you had a well-structured, seasoned whole life policy, and a financial advisor who is securities licensed comes in and says, hey, you should surrender that policy, take the cash value and put it in the market because you'll get a better return on your investment. There would be no problem with that, even though that is clearly not in the client's interest. That would be a disastrous decision to make. If you really want to make the investment, just use a policy loan from the policy and go and buy the investment. You don't have to surrender the policy.
You're right. I could,
yeah, but the point I'm making is, let's not be naive about this. Okay. When this guy keeps saying, I'm a fiduciary and I'm acting in your best interest. No, the way the rules are set up are so that you can act against the client's best interest and in the interest of your Wall Street superiors. So you can fight tooth and nail to keep the guy's money locked up in jail and threaten him and bully him so that he never does a reverse mortgage or a whole life insurance policy or an annuity or long-term care insurance. You can do that all day long and put it in writing. because there's no problem with it. Wall Street will have no problem with that. They'll applaud you and say, yep, you're acting in the client's best interest, right? Whereas if I come in and dare to suggest that, maybe this money locked up in a Wall Street jail, maybe you want to get some of it out. And yeah, there's going to be penalties and fees associated with that, but it's probably better for you to get your money out, because the opportunity cost of leaving it in there is going to be way worse if you don't get it into whole life insurance, if you don't have long-term care, right? If you don't get guaranteed income from an annuity, right? All of a sudden that's, oh, you're not being a fiduciary. You're not acting in the client's best interest, right? So again, let's not be naive about this. It's very simple. The rules and regulations are set up in such a way that if you are encouraging clients to put their money into assets that Wall Street controls, no problem. But if you dare suggest that one of your clients might want to take money out of assets that Wall Street controls and put it into a superior asset where you, the client, now have control, that is not allowed.
Yeah, I can vouch for that. Yeah, as being securities licensed, I could easily cash out a big whole life policy instantly. And then I could just say, well, he's going to make more. It's easy. Oh, he's just going to make more in his mutual funds, right? There it is.
Right. And Peter, any idiot, this is where I love saying, hey, I'm the little boy who points out the emperor has no clothes. Any idiot would turn around and say, well, Peter, can you prove that? You say he's going to make more money in the market. Can you prove that, please? I mean, if I'm going to do that, I would like to some evidence for that, please. Right.
No, it's well, I mean, it's hypothetical, but
Right. It's all based on this assumption. It's just an assumption. There's no science behind it. Okay. It's just, yeah, the market goes up at 10%. And again, when they say the market, they mean the S&P 500. Okay. Maybe that, even if that is what it's done in the past, how do we know it's going to do that in the future? Prove it. Please demonstrate that to me. They cannot.
Right.
They cannot. The best they can say is you're playing the odds. I'm like, okay, so we're gambling. You're telling me to gamble with my hard-earned money and hope for the best, right?
S&P goes up roughly 63% of the time. It's down 37%. Okay. Now that's only past historical during quote unquote the good times. And I think going forward, let's face it, this economy doesn't really work. Unless the government's printing money, this economy no longer works. So do we really believe that it's still going to stay up, going up 63% of the time? And even if it does go up 63% of the time, if the 37% when it's down are really bad downs, how's that going to work out, right? So,
and how much income is it giving you? How much income are you collecting from it? What's it doing for you? How is it improving your lifestyle, right? For most people, their best investment is their full-time job. It would behoove you more to work for a promotion at your full-time job. That's going to impact your lifestyle. That's a great investment, right? You put in the sweat equity to get a promotion, and you're making an extra $30,000 a year. That has a great impact to your lifestyle, and that's money in your pocket. That's where you should be focusing your attention, not putting money in quote unquote the market and hoping for the best, right? Keep it all in cash. I personally, when I was, when I first started making money and I was exploring like what to do, right, and asking financial advisors and coming in with an open mind, I never got any good answer to why, right? The childlike question, why? Why would I do this? Why? There was never any answer. It was all buy mutual funds and put your money in a retirement account. None of that ever made any sense to me. So what did I do? I stayed 100% in cash in a savings account. Guess what happened? The 2008 crash happened. I was 100% in cash. My portfolio did just fine. My portfolio smoked all of the experts' portfolio. Okay. And I apparently didn't know anything. I'm apparently an ignoramus, right? Apparently I'm not sophisticated enough to know I'm supposed to put in mutual funds and 401ks and all that, right? Okay. So whose portfolio did better?
yeah. And I look
did your clients who had whole life insurance, Peter, did their cash value go up, down, or stay the same through the 2008 crash?
Went up. But I tell you what, I had some people in variable universal lives. Guess what? Those things didn't do too well. And yeah. I will not do a VUL anymore. I watched, not good.
So that's where this Yeah, but that's where, so in variable universal life has its place. It's fine. But yeah, that's where this financial advisor, again, it's so disingenuous because he's confusing them all up, right? He's confusing variable universal life, index universal life, whole life, right? All this stuff. He's mixing them all up, acting like it's all one amorphous blob. That's like me acting like all stocks are the same, right? They're not. Okay. Stocks may be a good place to put your money, but obviously some stocks are better than others and they all are different. Okay. So yeah, you're right, Peter, because I've had clients come to me with variable universal life policies. If I was doing what this guy was doing, I'd say just surrender it, get rid of it, and put it all in the market, right? But since I know what I'm doing, what did we do? You can probably guess what we did. We 1035 exchanged their VUL into a whole life policy. So we kept all their cash value intact. We paid no taxes on it because it's a like for like exchange. And we now put it into a properly designed whole life policy where it's going to keep growing tax free with no market risk. And that was a great move, for these clients.
And let me just say as a disclaimer too, there's actually some new, I don't offer them and I don't plan on it, but there's some newer VUL products out there that are actually pretty decent. So as long as they're properly structured, okay. I'm not a big, but back in the day, it was very disappointing. So it's funny you mentioned that because yeah, that's a beautiful thing about whole life. Gosh, I put money into it. Everything goes up. Not only does my cash value go up, my death benefit goes up. It's a beautiful concept. I can't.
Yeah, it's phenomenal. When you pay a premium into a specially designed whole life insurance policy, you are permanently capturing that capital inside your personal economy where it can never escape and where it earns for you from now to the day you die. And you can tap it anytime you want without interrupting that earning. And if something happens to you and you die, that death benefit pays out. If you have a long-term care need, you can advance yourself a portion of that death benefit. You get diagnosed with a terminal illness, you can advance yourself a portion of that death benefit, right? So yeah, but with VULs, like I'm not for or against any particular financial product. The way this guy is like dead set against whole life insurance is just evil, 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 right? I'm not for or against any financial product. Depending on what your goals are, depending on what your situation is, what your overall strategy is, and how it's designed, any of these products could potentially work for you, right? Yeah. I have no problem with them. I have no problem with a VUL if it's set up properly in the right way and you know what you're doing and it makes sense for your strategy, no problem, right? For my clients, it made sense to 1035 exchange the VUL into a whole life policy, right? And it was a great move for them. Okay. So just to drive that home, talking about bringing it back to the infinite banking concept, when I had a client who did that, you know what she did? Here's how she reclaimed the banking function for herself. Okay. After we 1035 exchanged her VUL into a whole life policy, she took out a policy loan and paid off all of her credit card debt, all of it in one fell swoop. And she started making repayments. So she took the same monthly payment that she was paying on these high interest credit cards and made it as policy loan repayments back into her policy on a monthly basis. She just became her own banker. She's not paying interest to Wells Fargo anymore. She's making those payments to herself, and all that money is earning for her. She just recaptured the banking function for herself, right? And even notice how this financial advisor, he never brought up debt, right? He doesn't know what the infinite banking concept is. So why would he bring up debt? He keeps trying to compare it to an investment vehicle.
Right. Absolutely. Just like we got to wrap this up, but it's just like when you hear people, I'm paying for something with cash, right? And I'll use some of the wording you like to use. Well, that if you're paid with something with cash, that's going to leave your personal economy forever, right? Someone else is going to make money off of that money for you. You're never going to make any more interest off of it, right? I mean, my gosh, that's in a nutshell, that's infinite banking. Never have that money leave your personal economy. It's brilliant. It's a brilliant concept. I just love the way you actually use the wording. It's beautiful.
Thank you. I pride myself on educating people, something this financial advisor never does. It's all about manipulating people into throwing your money into his hands, right?
Right. All right.
I don't take anyone's money away from them. I give you back control of your capital. that's what I do.
Wonderful. Wonderful. Thank you so much, Logan. So think we're gonna do a part 9, and we're just gonna summarize everything one more time, and maybe we'll have some other, we'll just kind of like we've been doing here at the end, just talking back and forth. So anyways, thank you, Logan. Have a good rest of the week. Everyone stay warm. I think we got a cold front coming in here. I think here in Tennessee, we're gonna get down to the mid-20s actually. So there's that whole global warming thing is kind of going out the door right about now. No, I'm just messing with everybody. All right. You guys have a great one. God bless. Godspeed.
Thank you, Peter. God bless.